Mutual funds investments are subject to market risk. We come across this tagline very often. This is a disclaimer published by the regulatory body, SEBI, about mutual funds, warning investors of the risks associated with mutual fund investments. To understand this, we need to understand what is market risk. Some basic market risks that investors should know about are price risk, liquidity risk, credit risk, and interest rate risks. Let's understand each briefly. Price risk with respect to stock market means that the share prices are not fixed. If today's price of a stock is 100, tomorrow this price can rise or may fall also. It may become 95 or it may become 105 tomorrow. A mutual fund's NAV replicates these prices and hence it's fluctuating in nature. Hence it is not sure whether tomorrow an investor may gain or lose. This is price risk. But this can happen with any investment. For that matters, even property or gold also. Gold or property prices may fluctuate, thereby giving you losses at the time of sale. Next risk is liquidity risk. Here, it may so happen that the stocks purchased by an investor do not find a buyer when needed, and hence one may not be able to sell out these stocks as per need. This is liquidity risk. But this may happen in case of real estate also. At times, a real estate asset may not get a buyer when required. Hence, this risk stands there also. Next is credit risks, usually in debt mutual funds. This means that money given as loans to somebody may not come back. But this may happen with your bank also. A bank may lend money to someone who does not pay back. Such a body who doesn't pay back is called a non-performing asset, or simply put NPA for a bank. A bank may become bankrupt as a result of increase in NPAs. We have seen this example in case of many private and corporate banks in the recent past. Banks suffer from losses due to their non-performing assets. Next category of risk is interest rate risk. This means fluctuating interest rates cause fluctuation in gains. The gains may be adversely affected by such interest rates fluctuations. In fact, banks control this factor by controlling interest rates. But we don't get to see any warning tagline before investing in real estate or gold or banks. Even the most popular and trusted safe investment, that is a bank fixed deposit, also guarantees to pay back a limited sum of amount if the bank files for bankruptcy. So, how do we define risk? Risk is the probability of deviations from expected happenings, or more specifically, the chances of occurrence of deviations from our desired results. We have seen that risk-free investment options like fixed deposits, post office schemes, and debt funds have limited earnings and have risks too. So if one wants to make more money than these risk-free investments, one needs to take more risk by exposing their investments to higher volatility in the market, that is, stock market. This means exposing investments to higher risks. Such investments may have one of the three outcomes. Number one, may lead to gain. So the gain may be higher than the risk-free return or may not be. Second, it may lead to no gain and no loss situation. This means definitely lesser returns than the risk-free return or no return at all, but no losses also. The third condition is it may lead to losses, which means loss of capital. Hence, one fact is clear that extra return is directly proportional to extra risk taken. Still, there is no guarantee. Hence, investing in portfolios of increased volatility, that is, stock market, to earn extra premium over and above risk-free returns, but without a guarantee, is called taking risk. I'll repeat that. Hence, investing in portfolios of increased volatility, that is stock market, to earn extra premium over and above risk-free returns, but without a guarantee, is called taking risk. Now let's understand types of risks. In general, there are two types of risks: unsystematic risk and systematic risk. Let's first discuss unsystematic risk. Now, do you remember the old adage? Don't put all your eggs in one basket. In our case, it means single strategy based investment, that is, entire investment in single stock or single sector stock or sectoral funds. This risk is firm and industry specific. Events like industrial recession, regulatory constraints, industrial action, loss of significant business contracts, product recalls of industries, sectoral recessions are examples of unsystematic risk. Such risks affect a few sectors more and may not affect the whole market to a large extent. Hence, 100% investment into only one such sector or fund may incur industry or product specific losses, and hence is riskier as compared to a portfolio wherein the investment is distributed among many sectors or multiple themes or multiple categories of funds. Let's understand systematic risk now. Systematic risk is a risk that is unavoidable. It affects the entire market and is not specific to a particular stock, sector, or theme. Some examples of systematic risks are pandemics like COVID-19, or war between two countries, or global financial crisis like the Lehman Brothers crisis in 2008, or recessions, interest rate hikes, petroleum prices variations, and political events. These factors are not in one's hand and hence cannot be avoided. More names of systematic risks are market risk, unavoidable risk, fixed risk, and undiversifiable risk. Volatility is an important attribute of systematic risk. It means unexpected nature. It refers to fluctuating prices of stocks as an effect of markets' ups and downs. Without volatility, there are no chances of high gains, though no losses either. But to earn high gains, volatility is important. So far, we have seen that not much can be done to avoid systematic risks. But minimization or reduction of unsystematic risk to a greater extent is possible. How? The answer is, do not put all your eggs in one basket. Put them in different baskets. Welcome to diversification of portfolios. What is diversification? Okay. Diversification is balancing the portfolio returns by adding stocks or funds or instruments with minimum correlation with each other. I'll repeat. Diversification is balancing the portfolio returns by adding stocks or funds or instruments having minimum correlation with each other. What is correlation? What is correlation? Let's understand. Correlation is a statistical technique that can show whether and how strongly pairs of variables are related. In our case, it tells us whether and how strongly are pairs of stocks or funds related. If two stocks gain and lose in sync with variations in stock market, then they are said to be positively correlated. Hence, if one goes up, the other also goes up, and if one goes down, the other follows in sync and goes down. This is undesirable for someone who is adding stocks to a portfolio to achieve diversification. For a portfolio to be diversified, it is essential that the stocks in that portfolio have minimal or very low correlation. Low correlation means that if one stock goes up, the other does not go up in sync with it. Hence, for a certain movement or event in the market, if the returns of one stock goes down, then the other stock's return remains unaffected or may go up to balance the returns of the portfolio and thus mitigate overall portfolio losses. Hence, for a portfolio to be well diversified, it is desirable that the stocks in the portfolio have minimal or very low correlation. So, we have seen that a high correlation between stocks do not provide desired diversification. With respect to a portfolio, diversification is achieved by adding more stocks or funds belonging to more than one sectors or different themes to that portfolio. Planning and investing in various percentages in a diversified environment like below reduces unsystematic risk in any portfolio. Investments can be diversified by distributing investments into various entities like index fund, which in itself is quite a well diversified option. Then there are sectors like real estate, gold, petroleum, automotive, metals, FMCG, power, IT, and many more. The graph shows the effect of adding diversified sectors stock to a portfolio. Now, as we can see clearly, when there was only one stock 1, in the portfolio, the total risk existed at point A, which is the highest point in the graph. By adding diversified sector stocks, the unsystematic risk comes down through point B and finally to point C, where the total risk comprises mostly of systematic risk or fixed risk. Here, we have reduced unsystematic risk considerably by stock addition. Caution should be taken that stocks and funds being added belong to different sectors or themes and bear minimum correlation, or for that matters, inverse correlation with each other.